Welcome to this panel. I think it's going to be a great panel. It's obviously a cutting-edge set of issues, and we have fantastic speakers today. So let's get going. I'm going to start with a very, very quick 2-minute primer on blockchain, ICOs, tokens, just because I'm sure a lot of the people in this audience know a lot, and some people don't know anything, so we're going to try to get everyone more or less on the same page. But I'm not going to be overly technical. I am a lawyer. I'm going to focus on the high-level description of what blockchain is, and then move on to our panelists. Blockchain is frequently described as a distributed ledger. The ledger part of that is that, in essence, blockchain is pretty much a really fancy spreadsheet. It works the same way as Excel. It tracks data, it tracks transactions in assets that are recorded on the spreadsheet. You can record anything on the blockchain. You can record assets, you can record transactions in assets, you can record how many hamsters you have because you bought a boy and a girl by accident. Whatever you would like, you can record on the blockchain. Blockchain is distributed in the sense that you don't have one person controlling the spreadsheet and the data that's entered into it. So someone in Siberia who is a programmer may be the person who is actually recording and verifying all the assets held on the spreadsheet and all the transactions on the spreadsheet. Essentially, they do that because everything on the blockchain has a unique identifier, which is a really, really long number and set of characters. And the person who is the miner or the programmer that's doing the tracking throws a bunch of guesses as to what that number is, and if there's a hit, then they've done the verification. And that's essentially how the blockchain is built. I'm sure if you know a lot about the blockchain, you are scandalized by this very high-level review, but that is for people who don't actually do the engineering, more or less how it works. Tokens, which we've been hearing a lot about recently, are really a part of the functionality of the blockchain. They're built into the blockchain, and they serve some sort of purpose depending on exactly what's being accomplished on a particular set of blockchain. Bitcoin itself is a form of token that was originally, or one of the primary purposes of it originally, was to serve as a reward for those who were doing the mining, i.e. the creation of the blockchain. And so basically that mining process would generate Bitcoin and was an incentivizer for people to actually get involved in blockchain building from the beginning. As you know, it is now available for purchase and sale. You can buy futures on the Chicago Mercantile Exchange in blockchain as of this week, and many people are making a lot of money on it. In fact, Jeremy has told us that he bought blockchain when it was $80, so he will be taking us all to dinner. There are other forms of tokens besides blockchain. Some of them are much like Bitcoin. Some of them are like Bitcoin in that they can be used as a form of currency. Some of them are proprietary, so they might be used as a form of currency on a particular platform. Some of them are not a form of currency, but more like something that unlocks a functionality or serves some other purpose on a particular platform. These tokens, as you may know, are now being used by many companies as a financing tool. The tokens are being sold in what's known as an initial coin offering, or ICO. And that ICO is a way for the company to make money in order to develop its platform and its technology and the tokens themselves. Usually the tokens are sold prior to their actual functionality being put into place, or at least when it's pretty embryonic. And as a result, you buy kind of the right to receive the tokens in the future when everything is actually functioning. There's a lot of debate right now about whether or not a coin or a token is a security. It's becoming increasingly clear that the SEC does view it as a security, and so the regulatory landscape around at least this portion of blockchain-related issues is changing quickly and in ways that a lot of companies are having to respond to also very quickly. I'm not going to focus on that particularly much, at least at this point. What I want to do now is turn to our panelists after that very, very quick primer and turn to the main focus of this particular platform, this particular panel, which is called the Blockchain, the Ultimate Disruptive Technology. I'd like each of our panelists to start by speaking for a few minutes about what it is, where it is that they think blockchain is going to be the most disruptive, and in what area it will be basically the ultimate disruptor of technology.
My name is Brian Fanzo, founder of iSocialFans, and I work a lot with marketing side of the house, and my background is actually 9 years of cybersecurity for the Department of Defense as a government contractor, really working with the idea of collaboration in cybersecurity policies between the different branches of the military. So I always tell people if they think their job with collaboration is hard, my job was getting the Navy to share cyber policies with the Army and so on. And I think this is where we're looking at blockchain, a lot of it comes down to how do we build trust. Ultimately, how do we get people to be able to share data that has a trust factor across the board? So I look at certain places where we're able to gather data, gather information, but there is not only a cleansing of the data, but there's also a lack of understanding of who's in charge of the data, where things are moving towards. So a lot of what I help brands do, or I look at as from a disruptive perspective, is rather than thinking about the influx of data that we have moving in, the ability to personalize the data as well as kind of move this forward. So I look at interesting space as far as collaboration, as far as employee data, both internal and external as employees move across. This is also something as far as verification of data. I think we're going to start to see this in the marketing space as social media data starts to be used for competitive analysis, business intelligence. We're going to be able to start to actually put some simplicity to right now where we have a lot of disruption as far as marketing data.
So I think that the fundamental disruption that blockchain introduces to the world that's super relevant for this room is that because there's no longer a need for a third-party intermediary when two parties are exchanging value or money, it allows for a monetary layer or monetary value to be built directly into software and protocols. And so the analogy that I like to use is, let's say it's 1990 and you want to make an investment and make a bet that this internet thing is going to be a pretty big deal. There are three vehicles you could have gone through. You could have bought public stocks in tech companies, you could have made a venture-style investment in a private company, or you could have bought domain names. And today the aggregate value of domains is in the billions of dollars. But what if you could have invested directly into the HTTP protocol, or TCP or SMTP? Or what if you could have invested directly into the Linux software itself and then have had the value of your investment increase in direct proportion to the user adoption and increase in adoption of that specific software or protocol? Well, in the world of Bitcoin and Ethereum, there are tens of thousands and soon to be hundreds of thousands of decentralized apps, cryptocurrencies, and the underlying protocol layer for what will eventually become the decentralized internet. And the biggest difference this go around is that when you're investing in these projects and companies, you're not taking an equity stake in a private company. You're taking an equity stake directly in the protocol or software itself. And then as that protocol or software gets adopted and as that network increases, the value isn't going to be captured by the private company building it. The value is going to accrue directly into the token mechanism itself. And that will fundamentally change everything we know about building companies, creating value, capturing value, and investing in assets. Because what that means is now a teenager in sub-Saharan Africa with a little bit of Ethereum on an app on his phone can make a venture-style investment into any token in any company in the world. And it's going to completely disrupt venture capital, and it's going to completely disrupt private equity. And it's going to bring democratization and constant and full liquidity to every asset that exists, including real estate and REITs. And so I think from a venture capital private equity perspective, this space is very important to be aware of what's developing.
I think these guys are definitely hitting the main target. I don't like to focus so much on how blockchain works. I think it's very cool. The technology is really exciting. But just like you don't need to understand that SMTP is the protocol that makes your email work, all you need to know is that email is faster than faxing. I think it's critical to understand what are the implications of the arrival of blockchain, or better said, decentralizing technologies. And I think the key word there is decentralization. When you have a centralized entity, you have three big problems that arise. The first one is you have risk. If any of you have your data stolen from Equifax, which is all of you, you understand the nature of the risk of centralization. The second thing that centralization introduces into the equation is time. So if we're all flying from here to San Francisco, is it better to fly direct, or is it better to change planes in O'Hare? That's never a good scenario. So you understand going through a third party introduces time. And the third thing, is it introduces friction and cost. These third-party entities in our lives, they're not altruistic, benevolent, they're in it to make money themselves, so there's a cost. Something like 30% of the insurance premiums that we pay, which goes back to our surge price presentation, to insurance companies, free shout out for you, man, I'll send you a bill later, basically just goes to keeping the lights on in these insurance companies. So what blockchain and decentralizing technologies allow us to do is to take out those centralized third parties, which historically have served a very important function by allowing them to broker trust between two people or two entities that don't necessarily know or trust each other. And for a long time, that was necessary. However, and as a history major, I realize how ridiculously large and obscene this statement I'm about to make sounds. My contention is that the history of the world fundamentally changed on January 3rd, 2009, with the introduction of the Bitcoin blockchain. Because theoretically, a blockchain and all the technology was possible. But in order to make this work, you needed three things. Number one is you needed high-speed networks that connected people. You didn't really have that to the late 2000s. You needed a lot of people connected to the network. You didn't have that either. And you needed powerful computers that could handle all the processing that Amy was talking about. You didn't really have that. Now we have phones more powerful than spaceships and all that kind of stuff, right? So the key thing to understand from this trend is it's really not about blockchains. It's really not about cryptocurrencies. Those things are all super cool. The key thing to understand is any entity that serves as a third-party trust broker is basically in the crosshairs of this disruption. So any business, that's what you need to be understanding is those entities, and you can go from platform businesses like Facebook, Uber, Airbnb, all the way up to MVA, Better Business Bureau, and everybody in between. Those are third-party entities, which in the future are not gonna be necessary. So if your business is based on brokering trust with two entities, this is the kind of thing you should start understanding now. And I think to Andrew's point here, it is like coming to you in 1993 and 1994 and saying, there's this thing called the internet, you may want to pay attention to it.
That's great. That's really helpful. So in light of our audience and the investment focus of this particular day, I'm wondering if you all can talk a little bit about, as an investor in a blockchain-related company, what are you looking for? What are the types of things we should be thinking about as potential investors in these types of companies?
There are two types of blockchains, primarily. There are private blockchains and public blockchains. Private blockchains basically means that everybody who participates in the blockchain network is verified is known entity and sort of accepted into the group. That's one. Then there's public blockchain, which means anyone can participate. So to me, that's analogous to the late 1990s kind of excitement around intranets. Everybody's like, oh, we're going to build all these corporate intranets, which is going to change enterprise. Versus the public internet. I think if you're an investor and you want to profit from what's about to happen, you should focus on the public blockchains. I think the private blockchains are going to be nice, they'll be sexy, they'll save a lot of money, they're going to, unfortunately some people are going to lose their jobs, they're going to reduce a lot of cost. But I don't think that's where the huge value is going to get created. Understanding how value gets created, to Andrew's point, at the protocol layer, what token economics are. I have a 9-page blog post trying to explain this, and I still don't understand it, right? But it's really it's a really different way of how value is created and captured because the fact that the data, but the systems are decentralized. So I would start to spend your time looking at these public blockchains and trying to look for huge networks where there's a huge amount of utility. To Amy's point, it's a question of whether it's a security or utility. That's a really important thing, but there's some really exciting opportunities out there, like decentralized storage, decentralized denial of service, like a company called Gladius or Filecoin or Storage. There's some really cool ones out there that say, okay, how do we create value in a decentralized way? Starting to get your head around that and understanding how value gets created, assuming this paradigm is as new as I certainly believe it is, and I could be wrong. I think that's where you want to focus your time and energy for this next wave. That would be my suggestion.
I mean, I completely agree. I think it's too early for consumer-facing applications, like mass adoption of consumer, because we still really haven't had our Netscape moment where I don't think anyone really knows what the user interface or browser into this ecosystem is exactly going to be. With that being said, right now, my interest and where I think the disproportionate value is going to accrue to is the underlying protocol layer, the HTTP and SMTPs of what will become the decentralized internet. Because the winners at the protocol level are going to be worth $1 trillion. And I mean, right now there are a lot of different interesting projects. One example is this one called IPFS, which is essentially a decentralized file storage protocol. And that protocol has something, a token mechanism called Filecoin built directly into it. And if you're an investor in Filecoin, if that's the protocol that wins in the long run, the value of that network is all going to accrue into that Filecoin. There are, as Brian mentioned, I think decentralized storage right now is super interesting and really developer tools, right? Because like Ethereum, for example, the reason Ethereum's price is increasing so much is because of the perceived adoption of all these companies that are building their decentralized applications on top of Ethereum. And so that's a good example of value disproportionately accruing to the underlying protocol and platform that all these developer tools or eventually consumer-facing applications are building on top of. Another example is this one called EOS, which is, and they're going to be Ethereum competitors, which is an Ethereum competitor actually built by a guy who used to work out of Virginia Tech's Corporate Research Center. And it's just a kind of different, each of these platforms will provide developers different tools, different proof of work, proof of stake type models. And so right now, from the investor's perspective, I think it's very important to try to understand what's developing, what's happening at the underlying protocol and platform level.
So I'm going to take this a step higher in the sense of understanding the consumer and the consumer's need for trust. You know, as millennials make up over 50% of the market today, make over 50% of all employees by 2020, one of the things you have to start to look at is why are things like real estate struggling? Why is banking something that has kind of missed the trust market? I think if you're looking at your customer or you're looking at a business that is establishing trust, today's consumer, especially that younger generation, I'm a pager wearing millennial, which really just means I'm at the top of the millennial spectrum where I had a pager at one point. BlackBerry was my favorite device. The generation that is younger than I am, the moving below 36 years old, the idea that none of them wake up in the morning with the concept that I trust a logo. There's a brand that I can relate to. So the idea of decentralization truly means for today's consumer, tomorrow's consumer, they can start to trust, not only trust in the architecture of certain solutions like real estate and banking, but also move forward with trusting where our data is going. You know, one of the things that I was inspired by Mike talking about this morning was transparency of data. If you look at a lot of the security breaches across large organizations, ultimately if Target would have been very transparent on how they were storing the data, where they were storing the data, or what they planned on doing with the data, 81% of the people that had their data kind of violated from the Target breach said they would not have minded if Target was doing that with the data. Unfortunately, transparency did not exist. Therefore, 100% of the people were up in arms with the lack of transparency when it comes to data. So this is something, as we start looking at every business, that's why I also believe it's going to transform everything we do, is trust is essential moving forward. We certainly don't trust majority of what's happening just north of us in DC. We don't trust many logos, many brands, many businesses. That trust can start to be established by ultimately allowing transparency of data, the sharing of data to be better understood, and also kind of working in a currency that matters or kind of means something without having that central point of failure. It relates to me that I worked at the Pentagon after 9/11, and our solution for solving the problem after 9/11 and after the WikiLeaks was putting glue guns and glue gunning the USB ports of our computers. The mice and the keyboard plug into the computer USB port. So that first Monday morning, one of the things that we realized was that you kind of put a Band-Aid on something and expect it to solve everything. And so when you're looking at trust I think is probably the thing that we fundamentally struggle with across the digital landscape. I do believe blockchain's the answer. You have to start looking at the fundamentals. You have to start looking at what businesses are investing in, and then ultimately how that can help you be more transparent in your data.
Great, thanks. Thanks to all of you. I have more questions, but given the time, I want to see if there are any questions from the audience before I pose mine. Yes.
So you briefly touched on, I think, the real estate aspect of the blockchain. I don't know if you guys can kind of elaborate on that. I mean, I think in terms of trust, real estate, banking in particular, when you have brokers, for instance, that's an area where, we as brokers, I think, struggle more than anything else, right? You have to establish that trust with your client. So in real estate, we already are outdated in technology. So when you bring in the concept of blockchain, certainly high level at this point, I think we're still all trying to discover that. Can you guys elaborate on what might be the thought process of, owning a commercial real estate asset for that perspective? Because kind of the way I'm thinking about it, if you're saying we're not investing necessarily in the company owning the real estate asset, right? So then, how does ownership, or how do people start investing in the building when you have to own the building as an owner, I think, to reap the benefits, if that makes sense?
Well, I'm not too knowledgeable in the real estate realm. But I strongly believe that every asset is going to be tokenized. And so what I think that means is that all this real estate is going to be represented on a decentralized digital ledger in the form of tokens. And the way I see it playing out is it's going to bring full liquidity to the real estate space, because you can buy 2, 3, 4% in a specific token that's attached to a specific building. That's the way that I see it playing out.
If you look at sort of real estate transactions, I think if you're anyone in the middle, like mortgage broker, title insurance, all those jobs, like, you're screwed. No other way around it. You are absolutely screwed. It's just a matter of time. I think the brokers have a chance on a value-added kind of thing, for sure, but the middleman, it's game over. It's just a matter of until everybody figures it out. And as far as the investment opportunity, I think Andrew's spot on, which is, imagine, let's take that $400 million Da Vinci painting that was sold the other day, right? Now, most of us can't, even if we bought Bitcoin early, we can't buy $400 million paintings, right? But imagine you could say, well, we could take that painting and divide the ownership of that into 400 million tokens. And you would say, I'd like to buy 2 tokens that represent 400 millions of that painting. And then you hold on to it, and at some point somebody says, well, I'm willing to buy your token. Instead of $2, I'll pay you $4 for it. Well, now we know that the value of that painting is 800 million. You just doubled your money, and it's totally possible. There's no easy way right now, given the amount of friction in the process, where you can own 400 millions of a Da Vinci painting, or 400 millions of this hotel. But in a blockchain-based world where tokens can be used and everything's digital, and you can take it out to 8 or 16 or 32 decimal points with zero cost, you can. So you are going to be able to start taking assets that are historically either completely illiquid or relatively illiquid and bring a tremendous amount of liquidity to it. So if you say, you know what, I'd like to diversify my portfolio, and I want to own a little bit of real estate in France or something, now you're going to be able to do that at a very, very low cost. And you say, I'm going to put $100 into some, beachfront property in France, and you can do that and prove that you own it, and then you're saying, I'm betting or I'm investing against the growth in the French real estate market. So I think that offers a whole lot of opportunities. The thing I would sort of take away, and I think Brian's point about the glue guns, it's a great story, and I think it's something to keep in mind, because when you see these waves of technology come in, there are traditionally two reactions. The first reaction is, oh wow, there's this really new cool technology. How do we use this to do what we already do, but do it better, faster, and cheaper? That's an important question, and you should ask it. But the really big important question to ask is, what new business models are now possible that were previously impossible? So if you go back to the 90s, most people said, oh, I can use internet to do what I do already faster. Like Barnes & Noble's like, hey, we can put up a website to sell books. Fantastic. Amazon says, we're going to create a digitally native entity. Facebook's going to do that. 20 years ago, none of us could have predicted Facebook, Uber, Airbnb. Those were previously impossible. And I think that's the kind of thing to be on the lookout is people are still going to want to own real estate. But what are the new ways that are going to be now possible because of this? And the tokenization is certainly part of it.
Yeah, the only thing I would add is I see WeWork is here. I've been working with a couple, the millennial Gen Z side, and a lot of them have been relating Bitcoin to the idea that they never thought they could have a office space in New York City in Times Square at the most premium location, but yet being able to sign up with WeWork and have that is part of this idea of Bitcoin at its blockchain at its highest level. The idea that you are able to have something that you've dreamed of but you never wished was possible because growing up that wasn't something that you could actually have, and now we're able to kind of decentralize while also allowing multiple people to invest in one larger piece.
Right. I just add a tiny bit of color to that. I think what can happen in the real estate market is that not only is the asset tokenized, but all kinds of information that's currently in a lot of different places can be attached to that. So title information, location, all kinds of other types of things that you have to kind of go to a local county office to find out, and you need the title search company and all the other intermediaries involved with can go away. Part of the interesting question is also, though, a lot of that is highly regulated. And so how does that regulation then get baked into the way that a platform that allows this type of thing operate? And I think that's also an area for a lot of creative thought. So, okay.
So folks, if I take what you're saying to its logical conclusion, are you saying that Wall Street just became buggy whip manufacturers?
There is an element of that. And if you ask, especially a younger generation, on what Wall Street means to them, there's not much of an answer. But if you ask them if Coinbase is on the front page of their iPhone, I can almost say 100% yes.
So I would add on, it's not just Wall Street, it's how we think about building a company, because what blockchain has done, and this is very slowly playing out, is that it's shifting the economic incentive away from building a private company to building open source, decentralized, user and community driven software.
There's one other thing that I think is important, which is, Brian made a great point about trust, and it's not an accident that when Satoshi Nakamoto put the Bitcoin blockchain out there, he embedded the front page of the Financial Times from that day, which was about another bank bailout coming in. There's obviously something going on here, but what's really powerful is you have to remember is like the money that's in your bank account, you don't actually control it. The bank controls it. At any point, they can shut off your access, the government can shut you down, you're out of luck, right? In a decentralized world, you control your assets. You control your data. Now that opens up an entire world of new responsibility. You lose your Bitcoin private key, there is no 800 number to call. You are screwed in a big time, right? And there are people who've done it and what have you. So, the idea that data, we're not going to have data repositories. Like I wrote a 70-page book about marketing in a blockchain world, and one of the things that I was like, you know what? We're not going to have CRM systems, because no company's going to control my data. I'm going to have my data and basically give the company the opportunity to do it. So yeah, I think you're on to something here, because if you think about which entities have violated the public trust in a big way, the banks are pretty much up there really, really high. And so it's going to take a while. This stuff's not going to be here tomorrow. It's not going to be here next week. I would slightly disagree with Andrew. I think the Netscape moment for Bitcoin has happened since Thanksgiving. Like, it's now aware, but we can argue about that. Certainly the application, CryptoKitties, I guess, could be your Netscape moment, I guess.
What would you think? Do you think Coinbase is the equivalent? Is that
Look, hindsight's 20/20 on these things, but certainly something happened after Thanksgiving around that time frame where things just went absolutely crazy. I like to think it was our annual football game, but I'm not quite sure if that was the moment or not. But something's happening, whether there's an app or not, but it's gone. The way I've been measuring Bitcoin adoption is I look at the Wall Street Journal. A year and a half ago, Bitcoin was maybe twice a month in the back of the business section. And over the course of the last year, it's moved to the front of the business section, into the main section, and now it's on the front page, above the fold,
CNBC every day.
multiple times, right. And a year and a half ago, when I started talking about Bitcoin and blockchain, people were like, what the hell are you talking about? I never have those conversations anymore. So, but I could be wrong. I've been wrong before.
For me, it's when my dad starts asking about it. Then it's over. It's jumped the shark, and he has.
Hi, I have a three-cornered question. I don't know how they all fit together, but you do. It's a question of transparency, security, and privacy. How do they all interrelate with Bitcoin or blockchain?
That's a phenomenal question. And it is a balance. So certainly the transparency, again, so there are many, many different types of blockchains. There's not just one, right? So different blockchains offer different value propositions, if you will. Like the Bitcoin blockchain is not anonymous. There's not total privacy. It's pseudonymous, like you don't know it's you, but you know it's a given address. But there's total transparency, right? Then you have privacy. So for example, Zcash, which is one of the projects that I work with, for them, privacy is far and away. You can verify any transaction, but you don't actually know what happened in that transaction. There's something called zero knowledge proofs. It's unbelievably super cool. Basically, you can verify that a transaction happened without knowing the contents of the transaction, right? So they're very focused on privacy. And then the security is, that I think is one of the easiest ones to solve because that's baked into the decentralized element to it, which is by virtue of the fact that there are 10 or 1,000 or 10,000 machines, compromising one of them doesn't sacrifice the integrity of the network. So that's good. Now the flip side on the security is you control your data and your assets, so it's only as secure if you leave your Bitcoin private key on your front porch, you have a security problem. So there's a trade-off there. I don't know if you guys agree or disagree or want to.
Well, I mean, I agree. The Bitcoin and Ethereum protocols themselves have never been compromised or hacked. When you see headlines that there was a Bitcoin hacking, it was an application built on top of the protocol that was hacked, like not Bitcoin itself. In order to hack Bitcoin, you need to introduce more network power than anyone in this room can.
Universe.
Yeah, it wouldn't be possible.
Then, the number one threat to every business out there in the cybersecurity world is insider threat. Human error, employees leaking information either voluntarily or involuntary. The thing with what blockchain ultimately does is you then have an employee, rather than leaking the company's information, ends up leaking their own information. And so this ends up putting a lot more onus on the actual of the individual of the data. A big question does come, who owns the data in non-third-party transactions, especially when you're using customer experience, customer acquisition, customer support. This is something from an airlines that I've actually heard a couple airlines that are really looking at understanding that whole process where they're not even owning the airport or they're leasing the runway or the gate that they're at, but how do you pass a user through there? Blockchain might simplify a lot of that process where the user is going to be able to actually share a lot of the data with the different organizations. I know for me, I upload my Apple Watch data to my doctor every single time so that he can better understand diagnosing me for ADHD. And that rather than me doing a sleep journal, I now upload my sleep data from my phone, and that's something that for a long time looked like a scary idea for privacy. I had to sign 441 pieces of paper for them to get me to approve to do that. But for me, it's a lot of that risk versus reward. And then the exciting part about that question is the risk versus reward will now be put on the user's plate rather than on someone else's plate, as I was one of the ones that was hacked in that solution.
But the flip side is on that one, the flip side is in that scenario, you have the data, your doctor has the data, but Apple also has the data. And that's the thing that everyone should be nervous about is like all this information that's getting aggregated at Apple, Google, the FANGs, if you will, like that's your biggest risk because you have, the other night, I was, my 9-year-old, who of course is the most technologically savvy person in my house, was like, Alexa, start a conversation. And we started interacting with the winning AI algorithm for Alexa. And they said, what do you want to talk about? And they were like, well, here's some topics. So we said technology. And then they said, have you heard of net neutrality? And I was like, so at this point I took over the wheel from my 9-year-old and I was like, yes. And in this very innocuous way, they were like, well, are you familiar with Ajit Pai? And I'm like, yes. And they start doing, like, oh, I read this article and it was so nice. And all of a sudden I'm like, wait a second, this algorithm is seeking to manipulate my opinion about net neutrality in line with Amazon's policy objectives. And I'm like, you shouldn't laugh. You guys should be terrified. Like, that's what you don't want. Like, when that data is concentrated in proprietary centralized silos and the algorithms that are determined how that information is used and they control the interface, you think fake news is bad. This is going to get really bad. And this is where it becomes a huge problem. It's like all this stuff, all this data, which is really his health data, is now available to Apple. And then Apple can be like, we know what we can do. And we can manipulate you. We can change. We can do all kinds of things. And you're not even going to notice. That's why you should want this more than anything. Not that I'm passionate about this or anything.
Yes. All right, I think to be respectful of everyone's time, we have time for one more question.
So my question is about the currencies. Along the side of Bitcoins, there are other currencies that are on the rise. Ethereum, Ripple, Zcash. Any way to predict which currency will be adopted by large organizations? R3 by Amazon, IOTA by Microsoft. Every currency is based on how it's written, on the security, and is there a way to figure out which coin you invest in now so it grows further? Because obviously the currency based on the protocol that it operates, there's one, but others like Monero, they're being accepted by hip hop artists nowadays. So is there a way to kind of predict that?
I totally have the way for you. It's going to be like 50 Bitcoin, but I'll give it to you after that. Look, dude,
Charge Connectopreneur.
Yeah, talk to me. I'll send you my public key. You can send it to me. But, I look at 5 things when I explore these protocols. And look, there's a lot of overheatedness going on right now. Like Bitcoin, this will sound crazy. The Bitcoin price makes sense to me. It makes sense to me a little bit faster than I would have expected, but it makes sense. Ethereum feels a little bit high. Litecoin is like, I can't get my head around that one, what have you. But I look at 5 things. I call it the T3CG model. Okay, T, team. Is there a team behind this that can actually deliver the product? Second T, technology. Does the technology can it actually do what they're saying it can do? 3, token. This is the token economics that he was talking about. There are going to be PhDs in crypto economics and token economics coming out of universities in the next couple of years. How you design circular economies is one of the most fascinating things here because it involves like mechanism design, game theory, incentives, like, Kahneman-Tversky type stuff. So those 3. C, community. Is there a community of people who are passionate believers? You cannot drive the growth of these tokens without a passionate initial group of raving fans who totally believe in what you're doing. And then number 5, the G is governance. And if you're following Tezos, for example, that's a great example of governance not working. So and the good thing about blockchains is like you can build the governance directly into it and make all of these rules hard-coded. So I don't have a surefire way. No, I don't think anybody does, but that's the model that I use. And, but if it doesn't work, disclaimers and all that kind of stuff, so.
I think this is a great model. The space is it's super esoteric and it changes so much every day. Like if you listen to a podcast from over the summer, like it's just outdated. Like the information isn't relevant anymore. And like we're launching a show in the cryptocurrency space, basically Mad Money type format, but for cryptocurrency. And it's, I mean, in addition to Jeremy's point of team technology, a lot of these things that are being built, it's not just a market problem. Like it's a technology problem, and some of these projects we don't even know if they're possible yet. And so it's really hard to give you like specific fundamental analysis to like break down each different coin. The best I can do is if you divide the market cap or the network value divided by the number of the transaction volume, that's maybe like a PE ratio, kind of, but it's a crapshoot.
There's a great book by a guy named Chris Bernisky. He's probably the leading thinker on the planet in terms of understanding how you value crypto assets. He's amazing. It's going to take you like 17 times to read it because it's just really that, but it's phenomenal. I think the key takeaway thing is don't get caught up in the hype. If you want to put a little bit in here, fine. My general advice to people is take 1% of your assets, just 1%. Go put it in Bitcoin. Okay, if you want to put in other ones, be my guest. Put it in Bitcoin, and then don't look at it for 5 years. There's a 50% chance you're going to have nothing, like absolute nothing. And there's a 50% chance that this is the most valuable panel you've ever listened to. So look at it that way. But the key thing here all along is education, education, education. Just read as much as you can. Listen to it's the idea that we're experts here is a joke because none of us know what's going on, right? Like we're all trying to figure it out. So that would be my advice on that one. Is just go slow and don't get caught up. There are people who are putting in all their life savings in, and that's just a rookie move.
I would say, invest in understanding blockchain, not Bitcoin, right? So I think that's where I go with the conversation. I think the currencies are going to change. We're going to see fluctuation. A podcast that I absolutely love is called Bad Crypto, where two gentlemen, actually a good friend of mine, Joel Comm and Travis Wright, they simply discuss the news. And the funny part is I listened to episode 1 through 3 about 2 weeks ago, and I listened to the most recent episode, and they literally contradict themselves about 7 times in a matter of like 2 months. But to put you on a trend, that podcast started off as, I believe, 5,182nd podcast in finance. It just became the 7th most popular podcast in the finance side of the house, and it's simply a discussion like we're having here. So I think it is an education, but I think education on understanding the blockchain phenomenon is probably more of a return on your investment than the actual individual cryptocurrencies, because I think we have yet to see where those are going to go.
What I would suggest everyone who wants to get involved in this space do is go to coinmarketcap.com, which has a list of like the top 100, 200, 300 coins by market cap. If you filter by the percent change in a day, I think it's a very good exercise to, filter by the biggest gainers, the biggest losers for the day, and then maybe try to figure out yourself, okay, why did this increase 40%? Oh, they released their new wallet app. Or why did this go down 30%? Just, if you do that every day, I think that's a good way to try to start understanding the space.
I think you should just go to neverstopmarketing.com/blog and read that every day. But, I'm a little biased. Thank you. Exactly. A little.
All right, well, thanks, Jeremy, Andrew, Brian. That was fantastic. Lots of great insights. Thanks, everyone, for listening, and for a great morning.
Yeah, let's give it up for the awesome panel.